Hello, everybody. Welcome to Wednesday. The S&P 500 was up 0.1% today, so it eked out a gain. It was actually down for most of the day, so I guess that's an accomplishment. It's also the eighth day in a row that we've had an upturn, which is pretty incredible. Expect things to slow down here. We're already seeing some fatigue in this run. It's come a long ways in a very short period of time. It's not completely stretched out looking at the measures I'm looking at, but it's, the volume's kind of falling this week. So, the things that I'm watching in terms of the volume are coming down. And so I think we're probably due for some little, rest here at the least. We did manage to close again above the high that was set just a few weeks ago. October 11th. We've done that now for 2 days in a row, so that's good. And oil prices continue to soften. The bonds continue to rally here too. So these are all things that the market's looking at. The market really seems to be paying a lot of attention to what's happening in the bond market. Because again, bonds are sort of a competitive asset class, and if they're paying higher and higher interest rates, people start looking at that. It's a replacement of investing in the stock market. So when you got a 10-year Treasury, at 5%, which was very close to not too long ago, and the stock market average is 11%. Some people start buying those treasuries, and now that treasury's now fallen back down to 4.5%, and we've seen kind of the market rally during that same time period. So that's why we have green lights, across all of our, time periods, and for both bonds and stock, and because things are kind of doing well as far as that goes. Again, we've got a little seasonal push that's going on here, so we'll see how that plays out. We of course had Chairman Powell had a short, session today, bigger session tomorrow. We'll see how things go. Didn't talk really today about outlook on rates and those types of things. One thing that is probably going to happen, in my opinion, with all these Fed governors, including Chairman Powell coming out, I'm expecting them to get a little bit more aggressive in their rhetoric here, at least partly because they didn't raise rates at the last meeting and talked a lot about not raising rates because the bond market had already kind of raised rates for them. The 10-year Treasury going up to nearly, 5%, kind of tightens things without them having to raise rates. Now, of course, since then, the yields have dropped quite a bit. So I would think they're going to want to try to push that back up with words. They've been using their words here ever since, November of 2021 to try to, convey things. And it's in their interest to have to raise rates less, let the markets do their thing as far as that goes. And so I think they're doing the right thing. However, it's kind of irritating to watch, all of this happening and have all of these, gyrations that we're having in the stock market. I mean, the market's doing really well over the last 8 days. That's fantastic, but we're still not where we were at the end of July. We're not where we were, at the end of beginning of 2022. So, we got a ways to go. As a matter of fact, we're at roughly where we were 3 years ago right now. So if you had money in the market over the last 3 years, you're just breaking even on the S&P 500 anyway. So that's not unusual. It's just how the market works. It makes these big runs and then it kind of settles down for a while and then it falls and then that finally settles. And then, we kind of come back and there's great money to be made, but it doesn't always, it's not consistent. It's not a CD, doesn't go straight up. So I think one of the biggest things as an investor is just being able to understand those gyrations and kind of be comfortable with those, because that's how you make money. And we have a lot of clients that over the long term that have made great money in the markets. And so it's still a great place to be. And if you look at the really long-term chart, I've got one going back to the 1800s, lots of gyrations in there with the Great Depression and 2008 and all those things, but still very nice movement to the upside overall with the market in the long term. And I think there's only been one 10-year period where the market didn't make money. So it's not a bad investment place. We just sometimes have to be really patient with it. And we get paid for being patient is essentially what happens. So we'll get there slowly but surely. And in my opinion, things are better than, what I'm reading about, and the stock market's better, the economy's better, just as far as I'm concerned. We'll see if that continues, but that's what I'm seeing so far. And the market is responding positively, at least here in the short term. So, and we're doing the right things. We're still in the primary uptrend, where you have closed above this last high, which is great. So maybe we're reestablishing, because oftentimes you get kind of that first big move, which kind of maybe ended in July. Then you get that big pullback that happens on a regular basis. And then that next movement up could be the strongest movement. It usually is. So, that could go here, especially with that Zweig breadth thrust indicator flashing, buy signal on Monday. Again, that's only happened 18 times, and it was successful, a positive rate of return 1 year later every time. And average rate of return during that time frame was 23%, which is really spectacular. So a lot of things are happening, I think, that show me that the market's still hanging in there. But here in the very short term, don't be surprised if we see some softness just because we've had 8 days in a row, which is kind of a big deal. Usually the market will back up someplace, and with the volume falling too, probably. But not bad. Let's hang in there, and we'll keep going, and look forward to seeing what's going to happen tomorrow. And we'll talk to you then. Thank you.